Welcome back to All Things Money. I'm David Blain, and for tonight's viewer question, we selected a couple of questions that are very related to what we've talked about already on the show. The first question we had from several viewers talked about moving averages. You'll hear me talk a lot about moving averages and as an indicator of the overall trend of the market. One thing that we like to talk about also is moving averages are typically cited in more technical type analysis. We don't use them in that manner. We use them just as an overall indicator of the direction of the market to determine what sort of environment you're in. You want to invest slightly different if the market is in a positive trend than if the market is in a downward trend. And so we don't use moving averages as the typical trader may. We use them just to get an overall indication of the market itself. And one of the longer term ones that we like, that we talked about in the first segment, is called the 200-day moving average. And it's simply, to compute it, you take the average of the past 200 days prices. So, for example, in the Standard & Poor's 500 index, you would take the past 200 days prices, add them up, and divide by 200, and it would give you your moving average price. Some people like to front weight it, meaning that they give more weighting to the more recent day's prices. Some people exponentially weight them, called an EMA, exponentially weighted moving average, or SMA, which is simple moving average, which is simply the average. And so what this does is it helps take away the daily fluctuations. It's very hard. That's why we encourage people to turn off the TV. Don't read about the daily ups and downs of the market. You will literally drive yourself crazy. Even on a monthly basis or quarterly basis, these are still way too short of a time frame unless you have unless you're a day trader or something. But for your average long-term investor, if you're looking at these gyrations of the market on a daily or monthly or quarterly basis, that's way too short of a time frame. And so what the 200-day moving average does is it helps smooth it out. And if you look at that, you get an overall feel for the general direction that the market is heading. Once again, we like these moving averages to help determine the environment. If you're in a generally upward trend in the market and the moving averages are rising, it's a time where you can be a little bit more aggressive. The selection of the individual sectors or countries of the economy are not quite as important. We saw this last year when just about every market was in an uptrend, every market was moving forward. There were differences between different countries and different sectors, but the reality was most things were moving in a very positive upward manner. When the markets are in a downtrend, when moving averages are moving down, it pays to be a little bit more selective. If you're contrarian and you see that things start dropping below their 200-day moving average, it may be a time to start looking at that asset class as a potential recovery potential. I'd like to emphasize also that when we're looking at these, we're looking at averages on markets and sectors and things, not individual companies, not individual stocks. That's a whole nother sort of science, or if you want to call it that. We believe that the markets are fairly efficient most of the time, especially at the individual stock level. But when we talk about whole markets, we feel that there is some value in looking at the overall moving average of a large number of individual securities across countries, across markets. But we're certainly not advocating the use of moving averages for trading individual securities. So we hope that helps. Another viewer sent in an email stating that he noticed I often use the MSCI Index when talking about international stocks, and he wanted to know what the MSCI Index is. MSCI is one of the largest index providers in the world. It stands for Morgan Stanley Capital Index. And it was created back in the 60s when there was international investing was just kind of coming on the scene, and most of the indexes were U.S. based. You did have some country indexes like the UK index and the Japanese index have been around for a while, but for the most part, the tracking of global markets was restricted largely to the United States. So Morgan Stanley came along and created the MSCI family of indexes. And like the question said, these indexes typically focus on international investments, although they do have indexes for the United States as well. But the number one index that most people might be familiar with and is used is what's called the EAFE, the EAFE index, which is Europe, Asia, Far East index. And it tracks a composite of the European countries, Asian companies, and Far East. What it does not include, notably, is the United States is not in that, and it does not include emerging markets. And so it gives you a good proxy, like the S&P 500 does for the United States. It gives you a good proxy for the developed world outside of the United States. MSCI also has an emerging market index, which is quoted quite often, and it is a composite of emerging countries around the world, such as Brazil, Russia, India, China, and it is a good proxy for emerging economies. Of note, as long as we're talking about indexes, kind of a little trivia, within the world, if you look at the capitalization of all the countries in the world, Canada makes up approximately 4% of the world's stock market. But interestingly enough, it is not included in any major index. When it was originally started, the S&P 500 contained Canadian companies, and then the MSCI indexes were created, and so they didn't include Canadian companies because they were in the Standard & Poor's indexes. Well, then at some point Standard & Poor's changed its index and they excluded Canadian companies, and the MSCI indexes excluded them. So when you look at the two main indexes for the world, the S&P 500 for the U.S. and the MSCI EAFE for the world, Canada is left out. And so it leaves an interesting hole in people's allocation. So we think that Canada at 4% of the world is important. They have a lot of resource companies. So when you're looking at investing, just remember that Canada is left out of most of these major indexes. Well, that brings us to a close for today's show. We hope you enjoyed it, and we'll continue with this mid-year update next week. For All Things Money, this is David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.